All right. Today we're talking about another option strategy that I and many other traders use to maximize our results as often and as much as possible. As a dedicated options trader, I use multiple tactics and strategies on a daily basis, and in my opinion, so should you. Today we're talking about the skip, strike, butterfly. Now you might already be familiar with this, or you might think I'm talking about a secret kung fu movie. Either way, I want you to stick around because we're going to be covering the skip, strike, butterfly in depth in this video. And when we're done, I promise you'll have a better understanding of how to implement this powerful strategy into your trading arsenal. Thank you for watching this video. But before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. First things first, as always, it's important to refresh our memories on option trading and some of the verbiage we're going to be using in this video. I know this will be common knowledge to most of the veterans out there, but there are others out there who lack this foundational knowledge. So let's just go ahead and knock it out. Options trading involves dealing in contracts that give you the right, but never the obligation to buy or sell an underlying asset at a predetermined price. This is how traders like myself hedge against potential losses and increase our flexibility while generating reliable income. Remember, risk is the enemy, and while you can't completely eliminate it, options are a good way to mitigate it. Now let's get into some terms we'll be using. First, we have the strike price. This is the set price at which you can buy or sell that underlying asset, depending on whether you're using a call or a put. Another term is at the money. This means that the option strike price and the asset's current market price are the same. Finally, we have out of the money. This is the term used when the strike price is less favorable compared to the market price of the asset. So that's some basics for you. Now let's move on to the skip, strike, butterfly itself. When I first started trading options, I spent about a year using nothing but basic strategies like covered calls and naked puts. Eventually, as I got more confident and saw more success, I moved up to more complicated option strategies like bull call spreads, bear put spreads, and so on. Once I had this foundation in place, I moved on to advanced tactics like butterflies and condors. And I have to admit, it didn't take me very long to figure out that the skip, strike, butterfly is pretty unique in the world of options trading. Indeed, most options traders find it particularly useful for stocks that aren't overly volatile and are trading on the higher side. So let's take a closer look at it. The skip, strike, butterfly is what we call a three-legged call option strategy. Essentially, it strikes a balance between reducing risk and maximizing profits. As you can see with this illustration, the strategy starts with buying one call option right at the stock's current price or at the money. You then sell 3 call options at a slightly higher strike price. Finally, you buy 2 more call options at a strike price that's double the range above the difference between those first 2 options. More experienced traders will notice that the skip, strike, butterfly has its roots in traditional options trading with a little bit of a twist. That twist helps you better apply the strategy to specific market conditions and your own unique goals. Of course, this is a bare bones explanation, but we'll get into some of the more advanced stuff later. For now, let's see how the skip, strike, butterfly might work in practice. When it comes to setting up a skip, strike, butterfly, picking the right market conditions and underlying assets is key. Suppose you buy 2 long positions at a strike price of 95 and 110 and sell a short position at a strike price of 100. This creates a unique profit graph where your trade remains profitable below the strike prices, peaks at the second strike price, and then starts to taper off beyond that point. Of course, you can vary the strategy to fit different market scenarios by adjusting the strike prices and the number of options in each leg of the strategy. The versatility is one of the reasons why the skip, strike, butterfly is so popular. So let's look at a real work example. Here we have JP Morgan Chase. This particular stock is currently stable and shouldn't rise much in the short term. This makes it an ideal candidate for skip, strike, butterfly strategy. As you can see from the details I've entered here, the net of opening up this position is a credit of 26 cents. If I plug this into my own profit graph, you'll see the familiar shape we just looked over. According to the chart, my profit would increase as the stock price rises to the second strike price of $160. However, Once it passes that point, my profit will decrease slowly until the stock hits roughly $162. As the stock price goes up, my loss would increase until the stock hits $165. At this point, it's maxed out. If you look more closely at the shape of this chart, you'll note that what we essentially have here is very similar to a standard butterfly spread. That's because it's essentially a small bull call spread and a larger bear call spread combined. They simply overlap at the short call position. The embedded short or bear call spread is designed to offset the cost of the long spread. This allows us to establish a strategy to get that net credit. That said, the larger short call spread also adds a bit more risk than what you'd see with the traditional butterfly. But don't let that scare you away, because I'm also going to show you some ways to manage that additional risk. So when would you use a strategy like this? Well, in the simplest terms, the skip strike butterfly is best implemented when you think the stock might go up a little, but to the point that it actually doesn't go far. This is important because you don't want to be holding a position like this if the stock skyrockets. If you remember from my example, the ideal approach is to open this position for a small credit. That way, if the stock holds or drops, you can still profit from the trade. Now let's talk about reducing overall risk. Like I said earlier, the larger short call spread portion of the strategy adds more risk compared to a traditional butterfly spread. To manage these risks, you might consider using stop loss orders or adjusting your positions as needed. Of course, keeping an eye on the big picture indicators like market volatility, time decay, and liquidity is also a good idea. That said, I find that tweaking the ratio of options is extremely effective at reducing your risk. For example, you might consider a 1 to 2 to 1 ratio instead of the more aggressive 1 to 3 to 2 that I've shown you. This adjustment will reduce your initial credit, but also limits potential risk. This is the same trade-off we see in all investing strategies. There's a sweet spot for everyone, but you're never going to find a perfect solution where you get free money without any risk at all. However, if you do decide to try the 1 to 2 to 1, you'll be profitable at a wider price range, which I have to say mitigates far more risk than you think. In the end, the most important takeaway I want you to have regarding the skip strike butterfly is that it works best the less volatility there is. This is why index tracking stocks like SPY and QQQ are very popular for this strategy. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.